Well, hello, everyone, and welcome. Cynthia Tomaine once again with Interactive Brokers, and thank you for joining today's webinar where we'll be discussing modeling the strategies of Buffett, Gramm, and other investing greats. I'm very pleased to have with us this afternoon John Reese, founder and CEO of Validea.com. I also do want to let you know that we have on hand as well Justin Carbonneau, who is the Vice President and partner of Validea. So Justin, if you could introduce us to John, I'm going to go ahead while you're doing that and pass John the controls so that we can go ahead and get underway here today. Thanks for joining us, Justin.
Great. Thank you so much, Cynthia. I appreciate that. Hello, everyone, and thank you for joining us today. My name is Justin Carbonneau. I'm one of the partners here at Validea. I'd like to introduce you to today's presenter, John Reese, founder and CEO of Validea.com and Validea Capital Management. John has been developing and running quantitative strategies for over 20 years. He has degrees from MIT and Harvard Business School and holds 2 patents in the area of automated stock analysis. John will share much more about his background and experiences with you in a moment. I hope you enjoy and find value in today's presentation. So without further ado, here's John Reese.
Justin, thank you very much for the introduction. I'd like to begin by asking you in the audience a couple of questions. Can you tell me, by a show of hands, or more specifically by pressing the yes or no button, how many of you are looking for tools, resources, or new strategies to help you find good individual stock ideas? Click yes or click no.
Okay, I've just closed the poll, and you can see your answers on screen right now, John.
Actually, on my screen, I'm not seeing the
okay.
combined answers.
Well, what we are seeing is that 89% said yes, and 11% are not.
Excellent. Second question I want to ask you. How many of you have read books by or about the great investors like Peter Lynch, Warren Buffett, Benjamin Gramm, but not really known how to go about implementing those strategies in the real world in your own investing process? Click yes or no.
Well, it looks like what we're seeing, about a third said no, but 2/3 have responded yes in this poll, John.
Excellent. I'd like to share with you that I have also struggled to incorporate the strategies of the legendary investors. And part of what I'm going to share with you today is a process of how I've gone about doing that. So the goal of today's presentations, I'm going to share with you the fundamental stock selection strategies of 2 investors, Benjamin Gramm and Warren Buffett. We do offer 22 unique models based on great investors at Validea, and we've shown long-term outperformance with them. But we're going to really delve in deep into Benjamin Gramm and Warren Buffett so that you'll be able to apply it on your own. Then I'm going to show you what some of the current top stocks are from those 2 particular strategies right now. And then I'll even switch to the tools directly real-time on Validea.com so you can actually see what it looks like with the real-time analysis and the additional insight and information that you can get from that. I'd like to share with you my background story. It begins when I went to MIT studying for a degree in electronics and computer science. While there, I worked for MIT's Artificial Intelligence Laboratory to extract wisdoms for books so that computer programs, could actually implement the wisdoms that was in human teachings. Now, I didn't really utilize that at that time for the stock market, but as you'll see in my story, I did come back to that many years later, and that was a foundational experience that allowed me to do what I've actually done here. Went on to get a degree, MBA, Harvard Business School, went out in business in technology companies, founded my own company at the very beginning of the personal computer age, specializing in what was also then new at the time, local area networking, sold off my company. And that started the process. Okay, now I was looking for a way to invest the cash that I received from the sale of the company. And I was very interested in stocks and how to do that, and started reading extensively. At one point, I was reading 50 different business journals, from Wall Street Journal, Barron's, Business Week, Money, Smart Money, Fortune, Investors Business Daily, etc. And then I was reading quite a few different investment books, starting down the path, how to kind of pick stocks. And it wasn't really until I came across Peter Lynch's book, One Up on Wall Street, that I said, aha, there was something extraordinarily valuable in that. That one, he had a excellent track record. Two, he put down in writing, in a published book, how he went about picking stocks. And three, there were substantial portions of it that, based on my computer experience back at MIT, I said, I really, truly believe I can turn the wisdom in this book into a computer program. Not all authors, in fact, not many authors are clear enough where you can actually take their wisdom to do that. But Peter Lynch was, and had particular rules that could be incorporated into computer programs. I started publishing information on the internet, what I was finding, and I founded a company based on this, Validea.com, in the late 90s. It was granted 2 patents in the area of automated stock analysis. The breakthrough actually came in 2003, that I originally thought that I had a tool for the analysis of individual stocks according to these legendary strategies. So it could step me through each of the criteria of the investor and tell me, yes, this met pretty strictly the requirement of the investor, or no, it did not, and explain to me why, so that I could really begin to understand what they looked for. And it saved me very large amounts of time, looking up the data points and trying to work with them or insert them into a spreadsheet to try and analyze the individual stock, because my computer could go out and retrieve the individual data point very easily, whether it was the company fundamental or it was the last 10 years of earnings, whatever was required. And I thought that was valuable. But the most valuable thing in 2003 was that we put together models and model portfolios based upon these strategies, and started tracking the actual performance of the model portfolios. And that information is actually now available on the website, so we can see historically what have these things done under different market environments. I wrote 2 books on these strategies, The Guru Investor and The Market Gurus. The investment products of Validea are now used all over the world by investors for investing in U.S. stocks, but also in some particular countries, such as Canada and South Africa. We actually have native products using their particular stocks, and we're currently discussing with a firm in India actually applying these to Indian stocks. At Validea, we follow numerous guru strategies, including Peter Lynch's One Up on Wall Street. That was the book that was the foundation of it all. Peter Lynch is the manager who rose to fame on the Magellan Fund, did a compounded 29% per year, and is famous for growth at a reasonable price investing. Benjamin Gramm is widely considered the father of value investing, and professor at Columbia, and then had his own fund, but he wrote the book The Intelligent Investor, and one of his most famous pupils turns out to be Warren Buffett. Warren Buffett, of course, is well known to everybody as at any one particular time either the #1 or #2 wealthiest person in the world, with a very long-term successful track record of investing in the stock market. We also cover Ken Fisher, a very famous investor who wrote the book Super Stocks on using price-to-sales stocks, also formerly a long-term Forbes columnist. David Dreman is the famous contrarian investor, wrote The Contrarian Investor, and found that stocks that were low and underpriced, basically people expected too little of them, and therefore when they started to outperform, they did extraordinarily well, and found that positive glowing earnings estimates were usually highly overrated. Also a famous Forbes columnist. Joel Greenblatt basically wrote the book The Little Secrets, and a hedge fund manager put together a very simple strategy, the magic formula for investing in the stock market. Martin Zweig wrote the book What Works on Wall Street, and had one of the best risk-adjusted performing newsletters for 15 years, a regular person to appear on Louis Ruckhiser's Wall Street Week on TV. John Neff, the manager of the Windsor Fund for over 30 years, who beat the S&P 500 for 15 years. James O'Shaughnessy, who wrote the book What Works on Wall Street, a seminal investing study for over 45 years, showed it wasn't just price to earnings, but quite a few other strategies and variables ended up beating the market over a long period of time. Also a manager of his own fund. William O'Neill, founder of the publication Investors Business Daily, and inventor of the system called CanSlim for buying quality stocks that are accelerating earnings and momentum. And finally, one more, a little-known accounting professor from Stanford by Joseph Piotrowski, who it's well known that value stocks are what are known as high book-to-market stocks, what people call low price-to-sales stocks. Yeah, he asked the question, is there a way of separating the wheat from the chaff in selecting these stocks, so you find out the ones that are good from the ones that are bad? And he put together a F-score formula that allowed one to do that. Now, we've continued to add strategies over a period of time. There are other models and approaches from books and academic papers that we've used. So one of those is Partha Mohanram. He's an academic that published Separating Winners from Losers Among Low Book-to-Market Stocks Using Financial Statement Analysis, which identifies growth stocks that are supported by the fundamentals. It's almost the exact opposite of Piotrowski. Piotrowski looked at value stocks and tried to separate the wheat from the chaff. Partha Mohanram looked at high acceleration growth stocks and was separating the wheat from the chaff. Pim van Vliet is the manager of funds at a very large European asset management firm, put together work on low volatility and multi-factor type criteria for outperforming the market steadily over a period of time. Wesley Gray wrote the book on quantitative momentum, a very impressive academic, and runs the Alpha Fund. Tobias Carlyle is the author of The Acquirer's Multiple, which looks to value stocks basically like a private buyer would, using the enterprise value to operating earnings. So it's very interesting applying private equity techniques to the public stock market. Wayne Thorpe, based on Thorpe's paper, How to Profit from Revisions in Analyst Earnings Estimates. It models rewards firms with upward revisions in their earnings estimates. Patrick O'Shaughnessy, this is based upon the strategy outlined in his Millennial Money, which looks at a simple set of 5 criteria that get at the heart of factors that drive investment performance over time, such as value, momentum, quality. And a couple more, Dashin Wang, which is the twin momentum strategy based on his academic paper, Twin Momentum, Fundamental Trends Matter. It combines momentum in both fundamental and price momentum, which is very unique to do that. Meb Faber. Meb wrote Shareholders Yield, which basically looks at 3 ways that companies can return cash to shareholders, such as dividends, buybacks, and debt paydown reduction. James O'Shaughnessy, back with basically a second strategy. He has quite a few. Our first one is based on his combination of both growth and value stocks. The current one is based on his value composite that looks at several different ways of valuing value stocks and combines them together very well. So it was superior than just using one price to value factor, such as price to sales. So why these particular gurus? There are 3 reasons they were selected. Each has a long-term record of outperforming the market. They publicly disclose these techniques in either books or academic papers or other sources. And third, they created a quantitative methodology that can be utilized effectively in a computer program. All 3 are very key in terms of why these gurus and these papers were selected. I'd like to jump into the quantitative strategy of Benjamin Gramm. Basically, this is based on his book, The Intelligent Investor, which has been around for quite a number of years, and I still have a dog-eared copy of that particular book. But we're going to go into his strategy. The first step is one that he excludes technology companies. He includes public utilities, which were considered somewhat risky at that particular time, but he excludes technology firms. He also has a requirement for what makes a company of substance, and translated into current dollars and terms, he basically wanted to see revenues of $340 million in sales in order to say this was a substantial company. And if it did not pass that criteria, basically that would be a fail and he would not consider that company anymore. His second criteria had to do with the current ratio, and that's the ratio basically of the current assets of the company to the current liability of the company. And he used a current ratio of 2 as being an acid test for a company. So the company has to be pretty liquid to pass this particular ratio. He did make an exception that if the company was either a utility or telecom, that the current ratio could be less than 2, because he found with those regulated companies, their cash flow would be justified, and they actually didn't need to have as much cash around as the other companies. Step 3, he used the long-term debt in relation to net current assets, long-term debt, not just total debt, but long-term debt. And he looked at net current assets, which is basically subtracting out what does the company have on hand in cash and current assets minus what it owes in terms of liabilities. So this is actually a strong acid test. He wanted to know that the cash in hand and net current assets basically could actually pay and cover the entire long-term debt of a company. So if you're a heavy borrower type company, you're just not going to pass this. This is a real tough criteria for many companies that borrow today to actually pass. Step 4, he looked at the long-term EPS growth. Now, he wasn't looking for much growth at all, but he was looking for a positive bias that the company was growth. So he only required 30% over the last 10 years, basically, to grow. Not 30% per year, but it's more like 3% per year. So just a small positive bias for growth would be part of his criteria. And if there were negative earnings per share in the last 5 years, he would also exclude those particular firms. So notice that firms that pass his criteria are going to be profitable companies. Price to earnings ratio. In my study of the gurus, it's interesting, but only half the gurus ended up using any kind of price to earnings ratio. And when they did, they used some sort of unique or uncommon twist on this price to earnings ratio. Benjamin Graham's unique twist actually had to do with applying 3 years of earnings. So it was the price to 3 years of earnings ratio, and he did that to smooth out the business cycle of a particular firm. He wanted to see that the price to earnings ratio was less than 15. So in most periods of history, this is also a relatively tough criteria to meet. Nevertheless, there's still firms that meet this. But we also combine this with the price to book ratio. He didn't use just a price to book ratio by itself, but he utilized the multiplication of the price to book ratio times the price to earnings ratio, and in doing so, he wanted the multiplication of those two to be less than 22. So if a price to earnings ratio was already at the high point of 15, that really said that you could only have 1.4 something for a price to book ratio, relatively small. Now, as your price to earnings ratio went down, maybe your price to earnings was 10, your price to book ratio could go higher, up to, let's say, 2.2. But it was the interaction of these two terms that is important for him, not the individual term of price to book ratio. And another step was basically he wanted the total debt to equity ratio of an industrial company to be less than 100%. So his criteria to pass if that was the case. He was much looser with utilities and phone companies and railroads, and the long-term debt to equity could be as much as 230% for those particular types of companies. So with those criteria, let's take a look at what are some of the current rated stocks according to his criteria. Some that I'll point out to you have to do with Foot Locker that you'll see on top. I'll skip to United Therapeutics, Nucor, Mednax, Urban Outfitters, Westlake Chemical Companies. These are the current companies that pass his criteria. How is this particular model portfolio actually done? The Gramm Value Investor Model Portfolio on the Validea website has returned over 400% since its inception in 2003, and that outperformed the S&P 500 by over 200%. What you see on the chart, the light blue is actually the S&P 500 performance, and the dark blue is the outperformance of the strategy over and above the S&P 500. And this is showing the dollar value growth of a portfolio over that period of time. Now that I've walked you through the Gramm model and shown you the top stocks, I just want to take a moment to show you one of the pages on Validea. So I'm going to show you the page real time on the site. I'm going to switch. Give me just 1 second here. So it's possible at any time to come to the site and see basically the chart of the company, or a table of what the current portfolio holdings are. To scroll down to actually see the latest changes to the portfolios. And because this will be a annually rebalanced portfolio, if you want to see what the current top-rated stocks are according to the strategy, which is over and above what's in the portfolio, or maybe over and above what's in the portfolio right now, you're also able to see that on the website, another advantage of it. I want to mention that basically you're going to have full access and complete transparency into this model once you sign up to Validea for free for 90 days, which is something that I'm offering you at the end of this presentation. Very unusual offer. I hope you'll take advantage of that. Share with you some of my observations on the Gramm model. The Gramm model works best with annual rebalancing. Different models work best with different periods of time, but this involves less portfolio adjustments than other strategies, some other strategies. Concentrated models are very volatile, and you need to expect that. You're going to see times when it beats the S&P 500. You're going to see times when it's dramatically worse and out of sync with the S&P 500. That is perfectly to be expected from concentrated models that they concentrate on value. And one of the things I've observed is that the model will bring us into beaten down areas. One example of that would be retailers in mid-2017. For instance, you're seeing listed on the page 4 retailers that in June of 2017, the Gramm strategy liked together: Urban Outfitters and ZMUZ and CPRI and BKE, Buckle, were all retail stocks that many analysts were really disliked. Many other gurus disliked at that particular point. Yet the Gramm model found value in it. Now, that doesn't always work going into extremely unpopular, out of favors area, but it has been a net positive over time, and that's how this model works for its outperformance and actually making money. So I wanted you to be aware of that. Let's now switch to the quantitative strategy of Warren Buffett. The Warren Buffett strategy is unusual in that Warren himself has not written a book about his strategy. He's had writings, he's had annual reports that some people put together. That's not quite the same thing as a comprehensive strategy. I've read quite a few books about Warren Buffett's strategies that other people have written, but it wasn't until I came across the book by Mary Buffett, his ex-daughter-in-law, the book Buffettology, that actually had the best actionable insights for how to go about picking stocks using the Warren Buffett way, with numerous examples of how to do that. So let's take the strategy for Warren Buffett. And this is one of the more complicated strategies. There are almost 10 steps in this strategy. Step 1 basically is to ask, is this a Buffett-type company? What is the nature of the firm's business? Is it a leader in its industry? Does it have a national brand or regional brand? Is it number one? Does it have the ability to pass on costs? Is it the low-cost leader in its particular field? The complexity of the product or business model, is it relatively simple, such as carpets or bricks could be relatively simple. Now, he has a variety of firms, but to the extent that the business is simpler, that is actually better. These are more qualitative analysis than quantitative analysis, but in the end, there's only about 500 or 600 stocks that meet these particular criteria in the U.S. public market. The second step is earnings predictability. This is an extremely important criteria that he has. He wants to see 10 years, basically, of the same or increasing earnings per share and no years with a negative earnings per share. That's the best case. He has had examples of buying companies where the dips from a prior year altogether total no more than 45%. So that might be, let's say, 9 years ago there was a dip of 20%, and last year there was a dip of 25%. That's 45%. He could still tolerate, for if the company met all the other criteria, those kind of dips. But what he is doing here with this criteria is really interesting. Very few companies actually can pass this kind of increasing earnings and predictability test, but Warren is trying to get at the companies that he can have reason to believe their earnings projections 10 years in the future. Now, normally that's honestly foolhardy to try and predict or guess companies' earnings 10 years, a decade in the future, but by coming up with certain criteria, particularly this earnings predictability, he has a much higher confidence than most for being able to project this company's financials 10 years in the future. And that is part of the secret of his success. Next criteria is looking at the long-term debt of the company. He has an interesting little twist. He's not looking for a long-term debt ratio or long-term debt to equity, but he wants to know that the long-term debt ideally can be paid with less than 2 times the annual earnings of the company. He will accept up to being paid 5 times. In other words, 5 years of annual earnings of the company paying off long-term debt would be the criteria that he's looking for. If it's greater than 5 times, that fails. The company has too much debt for him. Step 4 is the return on equity. He's looking for greater than a 15% return on equity for each year for the last 10 years. Again, this gets into his looking for steadiness and reasonable ability to project it into the future. If it doesn't have that, or if it varies quite a lot, this company will fail on that criteria. Because companies can borrow and basically their total capital is not just dependent upon equity, but the ratios change depending on how much they borrow. He actually looks at the total assets of company, the equity plus the borrowing, and requires that for each year of the last 10 years that the return on the total capital be at least 12% per year. Again, this way he excludes companies whose financials have been goosed up because they have borrowed. Step 6 is to look at the free cash flow of a company. He wants companies that are tossing off cash after its investments and after operations, not ones that require huge investments for it. And this is a very important major criteria for him that he's taken advantage of quite a lot. Step 7, when a company retains earnings rather than paying it out in dividends, he adds up that money over a period of time, and he wants to see that the profitability of the company actually has at least a 12% earnings on the retained earnings that the company has kept around rather than distributed off to the company. This is a key way that he evaluates management effectiveness. Are they making the right decisions? Now, we've done a lot of criteria right there. Once the company passes all those criteria, even then, that is not saying, from Buffett, that is the right time to actually buy it. This is like a batter up at the bat, and that's a ball that's being pitched to him, but he has another very important set of criteria to know, is the price right? Is this the actual time to purchase the stock? He has several steps to go calculating the expected return of the stock. He does it not just one, but two different ways. The first way, he uses a return on equity method. So remember, earlier in step 2, we looked at 10 years worth of return on equity, and we found basically an average for DACT. We're able to project that forward 10 years into the future and come up with what is the expected actual return, what will the price of the stock be if the return on equity still continues for the next decade. Separate method, he actually calculates the price or stock of the company using the earnings per share method. If the earnings per share method continues to grow in the same way that it has, and again, one of the key assumptions here was he was able to select stocks whose earnings are predictable over the long run, or a lot more predictable than most other companies. You can come up with numbers. Using standard financial techniques, you're able to discount both of these back into the present time to come up with your estimated return on earnings and your return based on EPS growth to see if that's in the acceptable range. He likes to see a projected 15% annualized return from the stocks that have met all the other criteria. He has had examples, though, where he has purchased companies with as low as a 12% forward projected return. So there were two major fundamental portions of this. One is quite a bunch of criteria that ascertain the quality of the company, ascertain the financial returns, and give him reason for believing that this is projectable 10 years down the road. And then he's able to incorporate this into the formula that allow him to determine, is now the right time to acquire the company in order to gain the projected benefits 10 years down the road. What are some current top-rated stocks, basically, that pass this? You'll see Credit Acceptance Corporation, Medifast, Monster Beverage Corporation, Alpha Beauty, C.H. Robinson, a very large trucking firm, Ross Stores, interestingly enough, a retailer, TJX Companies, another retailer. It's very interesting, but Ross and TJX, as much as we tend to think about retailers as money-losing operations, these companies are all profitable and remain profitable. They remain profitable even during like the 2008 crisis. So there's a lot to be said for these particular companies. MasterCard, Apple, and we'll cover Apple in just a moment. There's something very interesting about that, and Toro Company. How is this portfolio actually done? Since 2003, this portfolio has returned 242%, which is outperforming the S&P 500 by 58% using monthly rebalancing and our 10-stock portfolio sides. Now, there was an awful lot of calculation that I mentioned on the Validea. And what I want to show you on the website, I'm going to actually switch to this. This is the live website, and you're seeing the portfolio and the current portfolio holdings, of which, interesting enough, if you see at the bottom, Apple's at the top. I'm going to click on Apple. And this goes back to the original purpose of Validea, which is allowing one to get a report card and a detailed analysis. How did he actually come up with these decisions? How do each company basically score on that? So the report card basically shows a abbreviated list of criteria. I have earnings predictability, share repurchase, the initial rate of return, expected returns. I'm going to just click on the expected rate of return. Actually, I'm going to scroll into that. What you're seeing on the screen is information on how these numbers were actually derived and calculated, what the current values are. So this will tell you why Apple actually met the current criteria of Warren Buffett. Amazing insight, saves hours of time in terms of analyzing a particular company. Some of my observations on the Buffett model is that I've seen to quantifiably identify moats. It looks at long-term consistent EPS growth, long-term consistent return on equity, long-term consistent return on total capital. It's interesting, but this model was scoring Apple 100% 2 years before Berkshire actually started buying Apple as a company. And as many of you probably know, Apple is now the largest holdings in the Berkshire Hathaway holdings of public companies. So the Buffett model actually predicted that. Now, the performance of the model does not mirror Berkshire year to date. It's interesting, but as of the end of July, the Buffett 10 stock model is up 26%, where Berkshire was up just 3% so far this year, actually struggling. There'll be times when this is reversing, but basically it's interesting that the model portfolio here is outperforming Berkshire. One of the reasons for that is that he himself states that he's very, very limited in terms of the companies that he can buy. They have to be elephants in size. We are able to offer and screen virtually, all stocks that are available on the U.S. stock markets. So it can pick stocks that are lower than his Berkshire Hathaway would be eligible to buy, providing they meet all of the other criteria. And I think that's one of the reasons that this is actually able to outperform Berkshire Hathaway at this time. So let's ask a very fundamental question. We've listed a variety of guru strategies. We've had original strategies since 2003. Do these guru strategies still work today? And the answer is yes, they do. I've been running these guru models in real time since 2003, and I'll share with you the overall results. 8 out of the 12 guru strategies are outperforming the S&P 500. The top performing strategy is based on a small cap growth strategy from the Motley Fool. And its annual return, if you notice on the top line in green, is 12.8% annualized. The S&P return over that identical period of time is 7.1%. So the outperformance of the strategy, also shown in green, is 5.7% per year compounded since inception. Number 2 is the growth strategy of Martin Zweig. And basically, you can go down and see, if you look at it relative to the S&P 500, 8 out of the 12 strategies are green and are outperforming the S&P 500 since inception. How about the new guru strategies that I've also mentioned? And the answer is that 9 out of 10 of the new guru strategies are also outperforming since we have been tracking them. The current number 1 is Dashun Wang's strategy, Twin Momentum. Remember, that was the one that is based on not just price momentum of the stock, but also a combination of fundamental factors, looking at the momentum of fundamentals. Are they going in the right direction? And that has currently had an annualized return of 20%, which is in excess of the S&P's 12% return since that time, or 7.9% per year in excess of the S&P 500. The number two at the current time is Parthenope-Hanram strategy, based on the price to book, basically the growth strategy, filtering out the wheat from the chaff in terms of the growth stocks. Before I get into questions and answers, I want to make sure that you're aware that I'm offering each of the listeners to this webcast 2 months free, not just to the regular Validea website, but the Validea professional version for professional investors and registered investment advisors, plus a bonus report for this. This is normally like a $1,000 product. You get 2 months unrestricted use of this to take your time to really actually try it out and see the observations. Use this particular code that's on here, www.validea.com/IB60 to activate your subscription. And at that point in time, when you actually get your registration to it, you'll also get a supplement that I wrote that's 5 keys that I found to successful quantitative investing. This link will only be live for a few days after the seminar. So if you want to take advantage of the offer, I suggest that you sign up immediately. With that, I'm going to take questions and answers. Happy to cover any questions, and please feel free.
Hey, John, this is Justin. We do have some really good questions that have come in, so I'll just sort of start throwing these out there, and we can get through as many as possible. So one of the questions was, how do you narrow the field to 10 or 20 stocks when more stocks pass a particular screen?
That's a good question. We assign a guru score to each of the stocks. There are several thousand stocks in the U.S. stock market right now. Each one is scored to each of the guru's criteria and receives a score from 0 to 100. And therefore, we're able to go down and start at the top, taking the top 10 or the top 20. If there are ties at the end, we actually resolve it with our secret sauce, which is we ask how many of the other gurus are also liking or voting strong interest in that particular stock at the current time, and we take the highest ranking stocks of that.
Okay, thank you. Hopefully that answered that question. Another one that just came in is how sensitive are the performance results to monthly, quarterly, or annual rebalancings? So I guess what rebalancing frequency performs best on average?
It depends on the individual strategy. It's not necessarily one, although I would say my overall impression is more frequent rebalancings actually do perform better, if you have to choose just one, than the annual rebalancings. That's not true for all strategies, particularly deep value strategies, but particularly if there's momentum or growth and you're buying with very low transaction costs, particularly if you use IB as your broker, basically more frequent rebalancings prove academically to actually be better than infrequent rebalancings.
Okay. Another question. If someone chose to follow the Peter Lynch portfolio, does your platform trigger when to sell a particular stock?
The answer is yes. We rebalance on a monthly basis, or actually more specifically every fourth Friday, and the new portfolio will tell you which stocks to take out of the portfolio and which stocks to replace them with. So yes, it does say that.
Okay. So this is another question, maybe just for clarification purposes. Is Validea a portfolio management company, or are we just making portfolio recommendations and suggestions that the investor then has to implement in their own account?
Validea.com is a publication and a research service, and it makes, I can't say recommendations, it says suggestions and model portfolios and does analysis and sends out very interesting newsletters and commentaries. I have a separate sister firm, a completely separate firm that is a registered investment advisory that actually manages stocks for affluent investors, manages their portfolios, and will implement the recommendations and implement the portfolios so that somebody doesn't have to work at it. But yes, with the research site, that is intended for somebody who is active and will follow the portfolio and then implement the decisions in buying and selling the stocks.
Okay.
The name of the other company, by the way, starts with the same name. It is Validea. It's Validea Capital Management.
Okay. There's a lot of good questions here. I mean, I don't think we're going to be able to get to all these. Let me just see. Can I see the model, all the model's criteria and the details if I become a member of Validea Pro? Which I think is probably just GRU analysis. So I'll let you talk to that.
So the answer is absolutely yes. You can. Validea Pro includes everything in regular Validea, but it includes the detailed GRU analysis. So yes, you can see each of the criteria step by step and apply that to any particular stock and see exactly how that criteria, currently applies without having to look up the values. It'll tell you how that criteria does.
Okay. Why did you choose to follow 10 or 20 stock model portfolios? Was there any particular research that went into in identifying or indicating the optimal number of holdings?
That's actually a very good question. The answer is 10 was just a very common number. It does not, by and of itself, it's not usually enough to be considered a diversified portfolio. At the absolute minimum, you want to see 16 stocks to 20 stocks to be diversified, and some would argue even 30 stocks for diversification. But we also came up with a 20 stock portfolio because we did want to have a minimally diversified model within a particular guru. So that was the criteria with how we came up with 10 stock and 20 stock models.
This is a good one. How often does Validea backtest these strategies to see if they are still valid as market conditions change? Basically,
we run a forward test every single day. The results that we present on the websites for the performance of these models are from the data that have been run for most of the models back to 2003 going forward. So it actually has the selections of the models on every single day. So you're seeing the results. So literally every day, just to answer in the gist of your question, the back test is basically being updated with actual results.
Okay. Okay, good. Let me just see. So is this available to UK residents, the Validea Capital Management? No, Validea Capital is just, I'm sorry, I'm jumping in on this one, just available to U.S. investors unless you're a U.S. investor living in the UK.
With a U.S. registered address.
Right. How many strategies are there to choose from on the Validea site?
On the regular Validea site, there are 12 strategies to choose from. The Pro model actually offers 22 strategies. Plus, we haven't really talked about it, a number of our pros want to know if there are particular country portfolios or industry portfolios that also do well. And we put those together as portfolios of recommendations so you can see the ranks of stocks within industries or countries on the pro version.
What strategy do you follow for your own portfolio?
I follow blended strategies for my own portfolio. First of all, understand that I eat my own dog food. I have my own money invested in my strategies. I have found it best, though, to blend multiple strategies together. It's not just picking one, because I found over time strategies do come in and out of favor, and I'm used to sort of second guessing myself. You know, is the strategy totally out of favor? Is it ever going to come back? This is a dilemma that I think most investors have, that they look at it's a recency bias. What is most recency? So to avoid those kind of problems, I blend several strategies together into ongoing strategies based upon what I'm doing, and then I invest in those portfolios. I have certain conservative versions, and I have certain higher growth aggressive versions.
Okay. I'm going to throw this one out here, and then we'll probably look to wrap it up in a minute. It looks like the questions are starting to wind down, but all these are really good. But this one is, I think, important, John, and it's talking about slippage. So monthly rebalance slippage question is relevant. So the question was, how much slippage is in there with monthly rebalance? And so this, investor is saying there's lots of screens that look better, but when you rebalance monthly, you have increased transaction costs and the slippage costs increase. So can you sort of just talk to that a little bit, particularly for someone that does want to follow, a more active monthly rebalance portfolio?
Sure. So the slippage costs come from two things. It comes from your brokerage transactions, and it comes from a difference between the bid and ask spread of a particular stock. Right now, depending upon the size of your portfolio, your brokerage costs for buying and selling can be 0.5%, it could be 0.1%, so it's almost negligible in terms of the cost. The bid-ask spread on most stocks in the U.S. Stock market are also relatively small these days, particularly with the advent of decimalization. I don't have a one particular number, but if I had to toss out something, for most stocks that are picked by the methodologies, and there's some liquidity requirements that we didn't talk about that are part of these, basically there's probably no more than a 10-cent spread between bid and ask, and probably not even that. So the monthly rebalancing costs, the slippage from that, are actually turned out to be very small in this modern day. This is contrasted to 20, 30 years ago, where each transaction you'd have to assume might have a 2% transaction cost to buy and to sell.
Okay.
And with that, we've just turned 1 o'clock in the East Coast, and I think it is time to say thank you very much. Turn it back over to Cynthia.
Okay, well, before we do wrap up today, I do want to show everyone that we actually do have the Guru report is available. There's a promotion going on for Validea, and it's currently available at no charge through August 31st in your Interactive Broker account. Let me go ahead. I'm going to grab the controls for just a moment here, and I'll show you how you can access that information. Now, you'll note right now I've brought up the Trader Workstation is visible on your screen, and to access that free trial period right now, you can go through the Mosaic interface, underneath the New Window button, you'll find access to analyst research. And notice right here, the Validea Guru Stock report is available. And again, this you can access this for no additional charge and right now on your Interactive Broker account. Simply log in and you can view this information directly from here. Now, if you're looking for more on Validea through that's now been integrated seamlessly on your Interactive Broker platform, let me also take you out to our website where you can find some additional information. Notice here we do have it listed underneath the pricing menu. You'll find research and news is provided here. This is a rather lengthy page. You can do a control find, but I do want to take you down and show you, notice down at the very since it's alphabetical, here we have Validea that's listed. You'll see here some information about this report, and notice here that you can actually learn more or click that button to go in and view some additional information about Validea. Notice there are sample reports available, and direct access to their website is accessible from within the Interactive Broker website as well. So I did want to point that out and let you know that that Guru report is available through the end of the month. But also do keep in mind what both John and Justin have talked about with their 60-day promotional free trial period. Now, do want to remind you, we've been recording today's session, and you'll get direct access to that recorded or with the recording hyperlink, as well as a list or access to the slides that John has provided today. And that free trial that's available, do want you to know there is a link included in today's slides that you can access and apply for that free trial period as well. So with that, we are going to conclude today's session. I do want to thank Justin Carbonneau for responding to a lot of your questions during the session, and also a great deal of thanks to John Reese for today's presentation. I also want to thank all of you for the time you spent with us here this afternoon and remind you to watch your inbox for follow-ups that will go out shortly. Thanks, everyone. You can exit today's event using the X in the upper right-hand corner of your screen, and do watch your inbox later on today. Thanks, everybody. Have a great rest of your day.